I think that it's important to understand the facility that the Fed created. So what the Fed did this weekend is essentially create a buyer of last resort again. If you look at all of the assets that are underwater because of all the rate hikes that Sachs talked about, and you add up all those losses, that is about $2 trillion. And the Fed didn't announce that there was a beginning and an end to this program other than saying these would be one-year loans. And so I think the exposure for the American banking system at a minimum is going to be this $2 trillion.
What a rapid currency dilution environment does is it puts every single person in that country on a treadmill to run as fast as they can to keep up with it, not just in terms of where to put their savings, but also how to continually increase their wages so that they're not just being completely left behind in global purchasing power terms, actual kind of international wealth accumulation, like richer on a global scale, the ability to travel outside of your country if you want to, for example, the ability to buy high quality imports like computers or cars or things like that.
If you're a banker right now running one of these banks that has not gone under, is to immediately go to the Fed, put all of those assets to them, get a loan, and now take that and buy different assets, different bonds, different US treasuries that are yielding much more than what your old treasuries were yielding. And I think that's the arbitrage that we've unfortunately created. And the other question now, though, however, is what does that mean for the top four banks, right? Because if it's $2 trillion for everybody else but the top four, what's the gap for the top four? That looks like it's somewhere between $1 trillion and $2 trillion. So that's another amount of money we're going to have to, or the Fed will have to backstop. And then, as Friedberg said, these checks always come due. What do we do in a year? Because in a year, the problem is the only way to make the banks in a position to repay this much money in 1 year is to cut interest rates so massively that these assets massively inflate, and now all of a sudden you're in a position to cover this. So
and
it's
describe what that delta is, because it's about, they're down 15%, 10% in book value, these longer term treasuries.
It depends on the security. Again, it depends on what they bought. We don't really know enough detail, so I don't want to guess. But if you own these 10-year treasuries, you could be off 10 or 15%. If you own mortgage-backed securities, it could be off a little bit more. If you own short-term securities, they're off a little bit less.
But these are with the government.
You get a loan collateralized by these assets. So you're still holding them, right?
Yes, and they mature.
So if the Fed takes an emergency posture and says, okay, guys, we want to avert a crisis in a year from now, and we're going to cut rates, these assets that these banks own will be worth more, which will allow them to repay the loan. As far as I can tell, all we've done is we've kicked the can down the road for a year. But I do think it's important for people to realize this doesn't solve the problem. It just means that mark your calendar for a year from now. We have a problem on March 15th, 2024, because all those folks that took money, what do we do?
What are your suggestions?
We need to have a real-time dashboard. We need to have a real-time dashboard at every single Fed that allows them, for every bank that they supervise, to know in real time. They can choose to ignore it. I'm not sure that should be true, but they are their supervisors. They should see it. They should choose to ignore it, but they should not have it.
The question of who you blame for this banking crisis has really become a political Rorschach test. And I've seen that there are 6 different parties that people want to blame in this situation. And there's some merit to all of them, but the degrees are very different. So number one, you've got the bank.
Let's go through them.
Okay, number one, the bank management of all these different banks. Clearly, very poor risk management, didn't do a good job. They are to blame. However, and Chamath is right about these banks, they differ in the details, but the point is that they're all operating under conditions of extreme stress. Where did that come from? Number two, the Fed's rapid rate tightening cycle. Clearly, I think that the combination of poor risk management with the spike in interest rates, that basically has precipitated this larger problem. Number three is, I think, the Biden administration's spending, which in fairness started with COVID before Biden, but Biden really intensified it. And then I think it really compounded the problem in the summer of 2021 by claiming that inflation was transitory when it wasn't. That allowed them to keep spending and keep printing money and kept QE going for another 6 months. That created the bubble of 2021. Everything got super frothy. And then that made the rate hike cycle even more vicious because you started 6 months later. They could have started 6 months earlier and it could have been more gradual. And I think that really was a disaster for the economy. Okay, number 4, the dereg in 2018. I think Elizabeth Warren and Ro Khanna have made what I would call a compelling case that the dereg in 2018 have contributed to this problem. I think in hindsight, creating a 2-tier system of banks where one tier are the systemically important banks who are completely guaranteed and backstopped by the federal government, and then a sort of lower tier, a second tier of regional banks was a poison chalice for the regional banking system, because in the short term, it meant they were more lightly regulated, which may be appropriate for, smaller banks that aren't these mega banks. However, it has also now, I think, created a situation where people are less confident about them.
So in the United States, money supply grows at about 7% a year on average. And, let's say money supply per capita, right? So if money supply is growing at 7% on average, money supply per capita is probably growing at 6% on average. If you're not keeping up with that, you're becoming a smaller share of the network. And there are other people that are, say, closer to the source of money creation, bankers, large corporations that can issue tons of long duration, cheap debt. They're basically shorting the currency that you're earning your wages in. And they're getting outsized. They're outperforming that, say, 6% hurdle, while the average worker is struggling to keep up, because anchoring bias is towards zero. So if I'm an employer and an employee comes to me and says, I want a 6% wage increase, my natural result is, are you 6% better than last year? And of course the answer is, they're like, well, no, but money supply went up per capita 6%. And I'm as good or better than I was last year. In fact, I should ask for a 7 or 8% raise because I'm a little bit more productive and more experienced, and I just want to keep up with the currency dilution. But that's not how things work. And so having this kind of constant money supply growth just kind of makes it so that if you're not a financial asset owner, especially if you're not a financial asset owner that's also shorting the fiat currency with long duration, low cost debt, you're kind of not playing the game. Or at least you're kind of blocked out of the winning strategy. And that's, that's why I consider money broken. It's basically the people who usually earn the most for the least effort are the rent seekers, basically the arbitraging this gap. Whereas I think a better world is where people that invent things, or people that run effective businesses, or people that are really good at their job. That's the type of people that should really succeed in this environment, rather than kind of arbitragers and financiers and leveragers and things like that. And so that's why overall I think money's broken, and that experiencing developing countries, not just Egypt, but Egypt's the one I have obviously the most experience with, really kind of helps with those details. On the monetary side, there's so much tightening. So if you're in an interest rate sensitive industry, if you're doing commercial real estate, if you're doing residential real estate, you're dependent on volumes and turnover. If you're a small business that has to rely on bank credit for your financing, these areas are struggling greatly. And many of them are in, if you do industry by industry basis, many of them are in deep recessions as it have been. On the other hand, if you're not very interest rate sensitive and you're on the right side of the very large deficits, you're pretty fine. If you're in the military industrial complex, if you're anywhere kind of near DC, if you're in, kind of just a lot of other kind of just real world businesses. And a key example I like to make is that, if you're an upper middle class retiree or near retiree, for example, you've built up a lot of assets, you own your own home, you might have a low fixed rate mortgage attached to it, and you own a lot of, say, money market funds and T-bills and stuff like that. Higher interest rates actually stimulate you because your debt is still fixed, any debt you might have, while now you're actually making more income from your investment. So the government's interest expense is someone else's gain, and that doesn't have the same sort of velocity or propensity to spend that, say, a stimulus check to a kind of working class person would, because they're more, their income and expenses are roughly matched, and so if they get a burst of income, they're likely going to spend it on consumer goods quickly. Whereas if you're wealthier and you get more money, you don't necessarily spend all of it. Some of it might just be saved, However, you're more likely to do international travel. You're more likely to buy luxury goods. You're more likely to help your kids and grandkids. Like if one of them is struggling and they have a wedding coming up, you might chip in. You might help them get their first house. And so that money does enter the economy. It's just in a slower way. And so we're seeing this really sharp divergence between fiscal policy, which is very loose, and then monetary policy, which is pretty tight. And then ironically, the tight monetary policy feeds into the loose fiscal policy by blowing out the interest expense of the government.